Hello and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hey there, Michelle. How are you?
Hey, Wendy. I'm doing well. How about you?
Oh, good. It's football season. I'm good.
Watching a lot of football.
Yeah.
Still hot where we are, as usual.
Yeah. So we'll see.
Yeah. So I just want to introduce our topic today. We are talking yet again about taxes because, taxes are everybody's favorite subject. And there's just a lot to know and a lot to get right. So I'm very excited to introduce our guest. We have a guest today. And his name is Madison Ross. He's a tax partner and co-founder of Ross Connor LLP out of, I believe it's Dallas. And if I got that wrong, I'm sure he'll correct me. And his focus is on small business, real estate, and individual taxation. And he's a licensed CPA in Texas and New Mexico. So very, very happy to welcome Madison Ross.
Thanks for having me, Michelle.
Yeah. So what we're going to talk about today is mistakes that you'll want to avoid. Just, we can't list them all or we'd be here for hours, but some common mistakes or some mistakes that you will definitely want to think about and avoid. And we're going to address about 5 of them today. So yeah, I'd like to get started. Maybe Madison, you can tell us just a little bit more about yourself and then we'll jump right in.
Yeah. So like you said, I'm a co-founder of Ross Connor LLP. We're here in Fort Worth, so DFW area.
Dallas, Fort Worth. Yeah. Same thing, right? No.
Yes, pretty much for most people. Yeah. So, we focus on not only preparing the tax returns, but also doing a lot of the planning, making sure clients are really thinking ahead and taking the most, getting the most out of their situation. So, happy to talk about some of the common tax mistakes that I see people make.
Absolutely. And it's a nice time of the year to do that because we can get a jump on tax season. So first question for you. People are enjoying their retirement. They want to make sure that their assets get passed on properly to the people they love. And so gifting a personal residence or rental property to their heirs before they pass on, that's a topic that comes up across your desk, I'm sure, quite frequently. So what should people be aware of before they gift a property?
Yeah, so most of my clients are below the estate tax exemption amount. So when I make this statement, what we're talking about here is I have those clients in mind who are below that threshold. But in almost all cases, you would not want to gift your property to your heirs. And the reason for that is because you lose out on what's called a step up in basis. So to kind of break that down, explain it a little bit, I'll give an example. If you have, let's say you have a father and he purchased a property back in 2005 for $100,000. And now in 2024, it's worth $250,000. So it's had this huge $150,000 gain, but he wants his son to have it. And let's just say he goes ahead and gifts that property to his son. Well, his son receives the same basis that his father had, that $100,000. So if that son goes and sells that property for the $250,000 that it's worth, he's now getting taxed on $150,000. So we don't like that. That sounds really bad. So instead, if you were to take that same scenario and now just flip it around, instead of gifting that property, let's say the father holds onto that property until he passes away. Now the son inherits that property at a value of $250,000. Now his basis gets stepped up to the $250,000. So instead of being $100,000 in basis, now it's $250,000. So if the son now sells it for $250,000, basis of $250,000, it's zero taxable income. So you went from gifting with $150,000 now to zero, no taxable income. So one of the other aspects to that is people, maybe they want that rental property or personal residence to only go to that specific child. So what you would do is you would set up a revocable living trust, put your assets into the trust, and then within the trust, you can make stipulations about, hey, this child gets this, or they can't receive, whatever asset till this age. It's great because even from your grave, it's like the dead claw coming out and getting to control your kids' lives with rules. So it's a little way to protect your assets, but also get that step up in basis.
And to that point, the revocable living trust, I'm a big fan. There's a lot of things that it can do. But to that point, you could also do a transfer on death deed here in Texas and a lot of other states. That's not considered a gift, right? Because it just happens upon death.
Upon death, then you get that step up in basis. So sadly, it's the key date is your date of death. So people don't like to talk about that, but that is the key. Yes.
And that way you wouldn't have to go through probate and all of that. It's a estate planning tool that can be used whether you have the trust or not, but it's getting away from this nasty capital gains tax that you're talking about.
Yes. Yeah. Yeah. We want to avoid those taxes. So
yeah, definitely. You don't want to pay a dime more than you're legally obligated.
Yeah.
So what about Roth conversions? I get asked this all the time. It's a big deal. It's a nice planning tool. But Roth conversions, people want to get their money into a Roth. But what are the mistakes or things they should be aware of?
Yeah. So this obviously, as you know, Michelle, could be an entire podcast in and of itself. But people want to get their money into a Roth because it grows tax-free. So there's a lot of caveats to it, but I guess one of the big mistakes that I like to point out to people is one, to remember that when you're converting over to a Roth, all that money is taxable. So what you want to look at is your tax bracket. So when it comes to the tax system, there's different tax brackets, and some of them make big jumps. So you have a 12% tax bracket, 22%, 24, and then 32. So that 22 to 24% tax bracket, that's a small little jump, not a big deal. But that 24 to 32 or 12 to 22, that's a massive jump. So when you're looking at converting over, you want to make sure that you're not bumping yourself up from a 24% all the way up to 32%. So, if you have $100,000 that you're transferring over, but you only have $25,000 of headroom before you reach the 32% tax bracket, well, maybe only transfer over $25,000 this year and do that for 4 years and spread out that rollover. That way you're not getting hit with a bunch of tax in 1 year. So that's something to think about. Obviously, there's a lot of other caveats, but that's one big tax mistake that I see somebody make, is just rolling it all over in 1 year rather than planning it out.
Yeah. And just a few others just to add to that. I mean, you got to know what you're doing. It's really best to involve a professional, is what I tell people, because you're also possibly going to trigger other unintended consequences like Medicare surcharges, net investment income tax, just to name a couple. So it's not, you want to know what you're doing. And here in my office, and I know it's definitely the case at your office, we use software. We don't try to do this by guessing. And so, I think Roth conversions are a wonderful tax planning technique, but not for someone to do alone. Would you agree with that?
Absolutely. Yes. You want to have software where you can really see the consequences of what's going on, where you can really make the best plan. And that's simply, neither me nor Michelle in our own heads could do all that. So you need software that's really helping make it clear and spitting it out correctly. So, yeah.
And you need to know what the software means, how to use it, what
exactly.
all. It's not just putting numbers in fields. I've had that conversation too with people. Yeah. Okay. So moving right along, another tax mistake, or not, you tell us, moving real estate in an S-Corp. So you've got an S-Corp. You're an S-Corp business owner. And why do you not want to put real estate inside your S-Corp?
Yeah. So sadly, I've seen this mistake way too many times. So I like to let people know why not to do it. So I could give many reasons. But if you think about it, real estate is not subject to self-employment tax. Whereas an S-Corp, the purpose of it is to reduce your self-employment tax. So it doesn't make sense to really move something that's not subject to self-employment tax into an entity that's for the purpose of saving on self-employment tax. Doesn't really go together. So I could list a ton of drawbacks to it, but two of the consequences is one, if you go back to our first example of that step up in basis, if your property is in an S-Corp, you don't get that step up in basis. Even if you hold it till your date of death, you lose out on that. So that's a big problem. Again, that could cost you or your heirs a whole lot of money. But then maybe this would be my second tax consequence is maybe you realize, oh, wow, I have my property in an S-Corp. Let me go pull it out. Well, in an S-Corp, when your property is increased in value, you can't just go pull it out tax-free. When you pull it out, you have a built-in gains tax. So you get into this situation where you're kind of stuck. Whereas if you have your property in a partnership or just a single member LLC, those you can get your property, distribute out your property tax-free. So that's where you don't want your property into an S-Corp. Again, I could list several more problems, but essentially you don't want your property in an S-Corp because it's going to cost a lot of money in the long run. So yeah, that would be a few of the tax consequences.
So, Madison, if someone is a business owner and the business owns their building, it's a piece of real estate, how should that building be titled? It shouldn't be in the LLC that happens to be taxed as an S-Corp?
So
what should they do?
Yeah, great question. So you want your operations in one entity, your ordinary income coming through, that's subject to self-employment tax. So we want that in the S-Corp. But your property, we want it over here in a single member LLC or a partnership in a separate entity. So one, that's for this purpose of not having your property in the S-Corp for those tax consequences we just laid out. But also from a liability perspective, if you have your property in the S-Corp together with your operations and somebody sues your operations, well, now they can also go after your real estate because it's in that same entity. So we want to create that separation, not only for the tax side of it, but also for the liability protection. So that's how we would do it.
This is why you need a good CPA and a good attorney, especially if you're a business owner, but even as an individual, because people just don't know these things, and you don't know what you don't know. That's my favorite expression. So, all right. So, moving to the next question, still talking about S-Corps. People want to avoid paying too much self-employment tax. Nobody likes self-employment tax. But what's the mistake people should avoid when thinking about moving their business to an S-Corp?
Yeah, so there's kind of two sides to this, but I would say one of the more popular mistakes I see is a lot of people hear it on social media. Hey, S-Corp, save you taxes. So what do? They go set up an S-Corp. The problem is S-Corps help save people taxes in certain situations if it's right for you. There's no one size fits all. So what people do is typically the mistake I see is they go and set up an S-Corp too soon. Either they only make $10,000 in their entity or it's day one of their business and they immediately start as an S-Corp from day one. So typically you don't want to do that. So that's one of the biggest mistakes is doing it too early, because when you create an S-Corp, you got to remember that now you have a separate business tax return, which costs a lot of money. Then you also have these payroll fees. So you have a lot of extra fees that come with becoming an S-Corp. There's some other things that go on that get really complicated, tax nerdy stuff. But essentially, if you're converting too early, it could be costing you money rather than saving you money. And on the flip side of that, I've had clients who come to me and they should have been an S-Corp years ago. They're making plenty of money to where their entity should have converted to an S-Corp. But because they didn't, they've lost out on thousands of dollars over the years getting hit with too much tax. So you really want to get with an advisor who can sit down with you, walk through when you should become an S-Corp, what it's going to save you. So what we do at our firm is we actually have an S-Corp analysis where we will look at your entity, look at the full situation. And look at, okay, what income level should you convert to an S-Corp? How much would it save you in taxes? And then not only that, but we also look at the fees that come with it to show you what would your net overall savings be. Because if you're saving $1,000 in tax, but then have $1,500 in extra fees, well, you're actually losing $500. So we also want to be transparent and show the extra fees that come with that. So that way, you know exactly how much overall you're saving. So it's important to really get with an advisor, really from day one, to make sure you're not converting too late or too early, because either way, it could be costing you money.
Yeah, and not that this is a big deal, but did you know that an S-Corp has a tax filing deadline of March 15th and not the standard April 15th? That's always fun.
Yeah.
You have to get your taxes done a month before everybody else. So, yeah,
Yeah, that's also important.
definitely
Yep.
want to, but you want to look at all this and not shoot in the dark. And I think that's the common thread here is, get good professional advice. Don't try to wing it. It's just not worth it. Um, all right. Can we talk about crypto for
Let's
just a
do it.
bit?
Yeah.
All right. So that's the last mistake we want to address today is crypto mistakes. It's become a hot topic, crypto, and a lot of people want to jump on the crypto bandwagon, but they don't fully understand the tax consequences of crypto. So what should people be aware of before investing in crypto?
Yeah, well, like you just said, first you want to understand what you're investing in. So a lot of people invest without having any idea what goes on with crypto, how it works. So you always want to understand, how something works before you invest. But when you get into crypto, it's important to make sure you're tracking your crypto. So it can create an entire mess if you're not properly tracking it. One of the best ways to track it, a lot of my clients use, is what's called a system called Coin Ledger. So it can help you track all your transactions, spits out your tax reports very easy, makes it a lot easier on you. So that's, I would say, my first key is to make sure you're tracking it properly. But then secondly, know how it gets taxed. So there's a myth that you'll see out online that crypto doesn't get taxed. You get all this tax-free money. The IRS isn't that dumb.
Yeah.
So in fact, the first question on your personal tax return asks you if you had any taxable transactions in digital assets, which includes crypto. So if you lie on the first question on your tax return, that's actually called fraud. So you want to make sure you're doing this right, that you understand it. And so understanding how it gets taxed, the IRS doesn't actually consider crypto to be currency like you would think of as a dollar bill. They actually consider crypto to be personal property, more like a forklift you can think of. So the ways it gets taxed, one way would be selling your crypto. Most people are aware of that one. That's pretty basic, simple. But what a lot of people aren't aware of is some of the other ways it gets taxed. One of those is if I exchange one coin for another. So let's say you have Bitcoin and you exchange it for Ethereum. Well, that's actually a taxable transaction. Another one is if I purchase something with crypto. So if I go get coffee and I pay for it with my Bitcoin, that's actually a taxable transaction. So you can think of it essentially, if crypto is leaving my account, it's going to be taxable unless I'm gifting it. But in almost all cases, if crypto is leaving my hand, it's going to be taxable. And then one last way is if I get paid in crypto, like for my job or as I'm a contractor, if I get paid in crypto, that is also taxable. And one of the mistakes that I've seen happen to people is they will get paid for their job in crypto. And as soon as they get paid, they sell it. So Coinbase or whatever system they're using will show, oh, you received $100 and you sold it for 100. So there's zero gain. So they think I have no tax.
Oh, geez.
Well, we got two different buckets here. They have no capital gains tax, but you have ordinary income tax on the money that you got paid for your job, just like a W-2 or 1099. They should be issuing you forms. They don't always, but whether they issue it or not, you're still supposed to report it. So you really need to understand all the tax consequences. There's a lot of ways it can get taxed. A lot of people don't understand it. So really, educate yourself before you get into it.
Well, and it sounds like you really need to have that software. What was the name of that software? We can put it in the show notes.
Yeah, it's called Coin Ledger. And yeah, I don't get any referral or anything like that. It's just a software that I've seen a lot of clients use.
So Coin Ledger, we'll make sure to put that in the show notes. But here's the thing. If you're not an organized person who is keeping track of all this stuff, whether it's through Coin Ledger or something else, And then you want your CPA to do your taxes properly. I can imagine you've had that situation where what are you going to do?
Yeah, we don't take those clients. So we tell them go get CoinLedger and get it fixed up. So it is something that
Right.
I've seen that situation where people have not been tracking it for years and then it becomes a mess. So the quicker you begin tracking it, the better. And it's basically impossible to do it if you're doing a decent amount of transactions. It's basically impossible to try and track it on a spreadsheet, CoinLedger, or any other system, TaxBit. They can help track all those for you, help you sleep at night.
Yeah, and we aren't going to talk about the investment aspect of cryptocurrency. That would be a whole nother topic.
Yeah.
And the safety and how to keep it safe. Those are topics people probably have heard or discussed. But what I haven't really heard a lot about is this topic of tracking it and the taxation. And it's super important to get that right, or you're going to have problems.
Mm-hmm. Yep, very, very much so.
I think that's the end of our badgering you with questions today, Madison. What's the final thought you'd like to leave with people?
So, all of these mistakes can easily be avoided, but it requires some planning, thinking ahead. So, at our firm, we're really big on planning. I know Michelle's big on planning, especially when it comes to the Roth conversions. So you always want to be thinking ahead. And we really like to provide clients with projections and make sure that they understand, hey, if I do this, what are the tax consequences? So there's a lot of very costly mistakes that we've gone through that could easily be avoided if they had just consulted a professional beforehand. So that's what would be the main point, and what I would leave people on is to encourage them, to make sure either you are knowledgeable or you're partnered with somebody who is knowledgeable, and making sure that you're planning ahead. So that's the key takeaway: plan ahead.
Plan ahead. And the cost of using a professional is often less than the cost of not using a professional.
Yes,
that's what I see.
Very much so. Yep.
All right. Well, how do people get a hold of you?
Oh, well, they can just go to our website at rossandconnor.com and get all our information from there, or email us at info@rossandconnor.com. And we can set up a 15-minute call to kind of see if you're the right fit for us, see if we're the right fit for you, and then go from there.
Thank you so much, Madison. It's a pleasure.
All right. Thank you for having me.
So, Michelle, how do people get in touch with you if they'd like to ask you some more questions?
Sure. You can visit our website as well, GessnerWealthStrategies.com. That's the best way to reach us, and we'd love to talk to you.
All right. Well, thank you both, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.